Let's take a look at some end of chapter questions on Alternative Investments Learning Module 7, an introduction to digital assets. First up, we have a benefit of distributed ledger technology, DLT, that increases its use by the investment industry is its. So we're looking for a benefit. A, scalability of underlying systems. Not so keen on A. You have issues here around those proof of work or proof of stake systems whereby you take time to put the work in to verify these transactions. That slows down the throughput and limits the amount of transactions it can process compared to a centralized system. So that's going to limit its scalability. So I certainly wouldn't say that was a benefit. B, ease of integration with existing systems, no. If you have a centralized system, you want to switch to a distributed ledger technology. You need to have a system that is decentralized and a database that's visible to every single participant. That's not going to be easy to integrate, so let's hope it's C. Streamlining of current post-trade processes, that is the idea of your distributed ledger technology. The idea is to try and cut out a lot of these centralized steps, cut out the need for an intermediary to start confirming things. The network does it for you via consensus. So streamlining, definitely. That one's got to be C. What is a DLT application suited for physical assets? A, tokenization. I'm all about that immediately. Tokenization, process of representing ownership of a physical asset via a token, is exactly a DLT application suited for physical assets. B, cryptocurrencies? No, not a physical asset. C, permissioned networks. Permissioned networks have a centralized feel about them, restrict access to certain parties. Certain parties can control, so it's more like a centralized network. So I don't think I'd say that is a DLT application suited for physical assets. Got to be A. A cryptocurrency miner can earn new digital assets by. Remember, cryptocurrency miners are verifying blocks to add them in to the blockchain. So what are they doing? A, solving complex algorithm puzzles to validate blocks of transactions. Certainly they do that in a proof of work system. Onto a blockchain network based on a POS. I know that's the wrong one. They're describing proof of work there, not proof of stake. So it's not A. B, staking his own cryptocurrencies to validate blocks of transactions. That is proof of stake onto a blockchain network based on a POW. No, that's wrong. So these two were just the wrong way around. Has to be C, validating and locking transactions onto a blockchain. That's what they're doing, irrespective of the consensus protocol adopted by the particular network. Yep, does not matter if they're using proof of work, proof of stake. Either way, by validating the transactions, they are mining new digital assets. The perceived value of a cryptocurrency depends on the following factors except. So it does depend on two of them. It does not depend on the third. A, the maximum supply of the cryptocurrencies. Yep. I'm going to put a little tick next to that. It's not the right answer, but it does depend on that, making it the wrong answer. If you have a limited supply and a high demand, that should give you value. B, the underlying cash flow of the cryptocurrencies. No. The answer is B, there is no underlying cash flow from cryptocurrencies. C, whether the relevant blockchain operates on a permissionless or permissioned network. Yes, that, plus the consensus protocol, POW or POS, can affect the perceived value. A and C do, therefore B is the odd one out and the correct answer. A key difference between digital assets and traditional financial assets is that A, digital assets are usually subject to a well-defined set of regulations. No, they are not. We said that in the module. They are not well regulated at all at this stage. Transactions in digital assets are most likely kept on private centralized ledgers. The whole module starts off talking about distributed ledger technology. Digital assets are valued not on their earnings. That is certainly true. They don't earn anything. But on the expected price appreciation given supply limitation. Yes, has to be C. Asset-backed tokens have the potential of improving the liquidity of the underlying assets because. So we have a token which gives us ownership of an asset or a fraction of an asset. A, they allow for fractional ownership, we just said that, they do, of high value assets. Absolutely right. So you're getting people who previously would not be market participants for this asset because they couldn't afford a whole unit, now being able to join in trading that asset because they can take a fractional ownership via an asset-based or asset-backed token, I should say. It is A. B, costs of validating the transactions are reduced on the blockchains. No. Currency, or rather cryptocurrency miners, get paid for verifying transactions. So there is a cost in there. C, they make it easier to trade the underlying assets on centralized exchanges. No, that's not what we're talking about at all. It's not B or C, it is A. Which of the following is the least vulnerable? Just pause whenever I see a least question. So least vulnerable to a computer security hack. Cryptocurrency wallets are vulnerable. Put a little tick there. It's not the answer I'm looking for. Centralized cryptocurrency exchanges. Centralized control is concentrated in one place. Can be hacked. Not the answer I'm looking for. Decentralized cryptocurrency exchanges. That's the point of distributed ledger technology. It is C, least vulnerable. We can hit one, but everybody on the network has a cloned copy of the distributed ledger. They can still operate. Has to be C. An investor who wants to replicate the return on Bitcoins without the use of a digital wallet, so I'm thinking here indirect investment. If you're directly investing in Bitcoins, you're going to have to get a digital wallet. Can best do so by A, investing in a cryptocurrency coin trust that holds Bitcoins. Yes, that is an indirect investment. So you're replicating the return, but you don't have to own Bitcoins yourself. Don't need a wallet. Investing in a listed cryptocurrency exchange stock. I'm going to take that as well. That is also indirect investment. You're getting exposure to the cryptocurrency sector without having to buy Bitcoins and get a wallet. C, buying Bitcoins from a centralized cryptocurrency exchange. No, you're buying Bitcoins. You would need a wallet. So it's not C. We're down to A or B. Wants to replicate the return on Bitcoin. So we're down to which of these two, given neither needs a wallet, which of these two is going to best replicate the return on Bitcoins? Has to be A. The coin trust holding Bitcoins is doing its best to replicate that return. A listed cryptocurrency exchange stock, well, not necessarily going to exactly correlate with the return on Bitcoins. The price of its stock is going to be affected by other market factors, company-specific factors, and so on. Has to be A. But which of the following is a key building block of dApps? A Bitcoins? A Bitcoin is a cryptocurrency. It is not a smart contract per se. B, smart contracts, yes. C, centralized exchanges. No, we're talking distributed ledger technology here. It's not C. The answer has to be B, smart contracts. They are the building blocks of dApps. Smart contracts, pieces of code that sit there waiting for information to come in, and when they get the right information, they will transact. They can automatically carry out a transaction when the information arrives or when conditions are right, price levels are hit, and so on. Has to be B. Compared to traditional equity investment, the historical return distribution of Bitcoin shows negative skewness. Haven't seen anything about that in the module. High mean returns. The module gave us a period of 2011 to 2022, I think it was, where the mean return was over 8%, crushing other classes. B, low standard deviation, no. All sorts of risk, it's definitely not C. It is a high mean return, at least for the long period they looked at. Despite higher volatility, cryptocurrencies may offer diversification benefits to an investment portfolio due to their scarcity value. Well, there's nothing about scarcity value that gives you diversification. You have to compare it to something else to get diversification. Expected higher return. Again, that is just a property of cryptocurrencies. It's not comparing it to anything. So A and B are both horrible. C, lower correlation. Well, that's diversification, lower correlation with other traditional investments. Absolutely. You have an investment that has a low correlation with others, you get diversification benefits. This is more of a PM question than alternative investments, but there you go. The answer has to be C. Price volatility of cryptocurrencies is high, most likely because they are A, subject to self-imposed limits on supply. Well, that's really talking about the level of price, not the volatility. It's telling you where the price will be. The fact that you have a limit on supply could, allegedly, props up its value. B, correlated with traditional risky asset classes. No, they're not. So B is wrong as well. Highly speculative. Yep. No fundamental value. Yep. And no cash flows. C perfectly describes cryptocurrencies.